High-frequency trading, or HFT, is like the speed racer of the stock market. It uses powerful computers and complex algorithms to buy and sell stocks in fractions of a second. We are talking milliseconds here, folks. These trades happen so fast, it's like blinking and missing it. But don't let the speed fool you. HFT has a huge impact on the market. HFT traders are like cheetahs, while regular investors are like gazelles. The cheetahs are incredibly fast and agile, and they can easily outrun the gazelles. But the gazelles are the ones who are actually grazing on the grass, so to speak. HFT traders exploit tiny price differences to make a profit. Now you might be thinking, what's wrong with that? Isn't that just how the market works? And you'd be right to a certain extent. But the problem with HFT is that it can create a lot of instability in the market. When HFT algorithms detect a change in the market, they can execute thousands of trades in a matter of seconds. This can cause the price of a stock to fluctuate wildly, and it can make it difficult for regular investors to get a fair price. So, HFT is a powerful force in the market, but it's not without its drawbacks. It's important to understand how HFT works so that you can make informed investment decisions. Stay tuned, because in the next section, we'll dive deeper into how HFT affects market volatility. Remember the flash crash of 2010? The Dow Jones Industrial Average plunged nearly 1,000 points in minutes. It was like a scene from a financial horror movie. While the exact cause is still debated, many experts point their fingers at HFT. These algorithms, designed to react to market changes at lightning speed, went haywire. They created a domino effect, sending the market into a tailspin. Think of it like a crowded room suddenly engulfed in panic. People start running for the exits, creating a stampede. That's what happened in the flash crash. HFT algorithms, sensing a shift in the market, started selling off stocks en masse. This triggered other algorithms to do the same, creating a downward spiral that snowballed out of control. But the flash crash wasn't an isolated incident. HFT has been implicated in other instances of extreme market volatility too. These sudden price swings can be terrifying for investors, especially those who are new to the market. They see their portfolios shrink before their eyes and wonder if they've made a terrible mistake. The truth is, HFT has made the market more volatile, like a roller coaster ride with unexpected twists and turns. It's not all doom and gloom though. There are ways to navigate this high-speed environment and protect your investments. Stick with me, and I'll give you the tools you need to survive and even thrive in the age of HFT. Let's bring this down to earth with a real-time example. Reliance Industries, a heavyweight in the Indian market, often sees significant HFT activity. Imagine you're looking at a live chart of Reliance's stock price. Suddenly, the price jumps up by a few rupees, then plunges down even lower than before, all within seconds. What just happened? Chances are that was HFT in action. Algorithms detected a large buy order coming in, perhaps from a mutual fund. They swooped in ahead of the order, buying up shares to drive the price up artificially. Then, as quickly as they bought, they sold for a small profit, causing the price to drop. This is called front-running, and it's just one of the many tricks up HFT's sleeve. Now, this doesn't mean Reliance is a bad investment. It simply means that, like many large-cap stocks, it's susceptible to HFT maneuvers. The key is to not panic when you see these short-term fluctuations. Remember, HFT is playing a short game. If you're in it for the long haul, focus on the fundamentals of the company, not the fleeting movements caused by algorithmic trading. In the next section, we'll equip you with the technical analysis tools to spot these HFT patterns and avoid getting caught in their web. Section 4. Technical Analysis. Spotting the HFT fingerprint. Alright, let's talk about technical analysis. Don't worry, it's not rocket science. Think of it as reading the footprints left behind by HFT algorithms. One telltale sign is something called quote stuffing. Imagine a fire hose blasting out thousands of buy and sell orders every second, only to cancel them immediately. That's quote stuffing. HFT algorithms use this to overwhelm the market with information, creating confusion and opportunities for them to exploit. On a chart, it might look like a sudden surge in trading volume, followed by an equally rapid drop, all without much price movement. It's like a phantom rush hour. Lots of activity, but no real progress. Another common tactic is spoofing, where algorithms place large orders that they never intend to execute. Think of it as a magician's distraction. They flash something shiny in one hand to draw your attention away from the real trick in the other. Spoofing creates a false sense of supply or demand, tricking other algorithms into making bad trades. By learning to recognize these patterns, you can avoid being fooled by HFT's smoke and mirrors. Remember, knowledge is power. The more you understand how these algorithms operate, the better equipped you'll be to navigate the market. But technical analysis is only half the story. In the next section, we'll explore the importance of fundamental analysis in the age of HFT. Section 5. Fundamental Analysis. The Tortoise and the HFT Hare. Remember the story of the tortoise and the hare. The hare, though incredibly fast, gets sidetracked and loses the race to the slow and steady tortoise. The same principle applies to investing in the age of HFT. While HFT algorithms are busy chasing pennies in the short term, you can win the race by focusing on the long-term fundamentals of a company. Fundamental analysis is like looking under the hood of a car before you buy it. You're not just looking at the shiny paint job, you're checking the engine, the transmission, the whole shebang. You want to know if this company has a solid business model, strong financials, and a competitive edge. These are the factors that determine a company's true value, and they don't change overnight because of some algorithm's whims. So how do you do it? Start by digging into the company's financial statements. Look at their revenue growth, profitability, debt levels, and cash flow. Read their annual reports and listen to their earnings calls. Understand their industry, their competitors, and their future prospects. The more you know, the better equipped you'll be to make informed investment decisions. Remember, HFT might be the hare in this race, but you can be the tortoise. Slow and steady wins the race, especially when it comes to investing. By focusing on the fundamentals, you can ride out the short-term volatility created by HFT and come out ahead in the long run. Section 6. Protecting your portfolio. Strategies for the little guy. So, how does a small investor like you and me survive and even thrive in this high-frequency jungle? First off, don't try to outsmart the algorithms. It's like bringing a knife to a gunfight. You'll get sliced and diced before you even blink. Instead, use their speed to your advantage. One strategy is to invest in index funds or ETFs. These funds track a specific market index, like the S&P 500 or the Nifty 50. Because they hold a diversified basket of stocks, they're less susceptible to the rapid price swings caused by HFT. It's like riding a large, stable ship instead of a tiny, easily capsized boat. Another tip, don't be afraid to sit on the sidelines. If the market feels too volatile, if you see those HFT fingerprints everywhere, it's okay to hold back and wait for the dust to settle. Remember, cash is king, especially in uncertain times. It gives you the flexibility to buy when everyone else is panicking and selling. Finally, consider working with a financial advisor. Find someone who understands HFT and its impact on the market. They can help you develop a long-term investment strategy that aligns with your goals and risk tolerance. Think of them as your guide through this high-frequency jungle, helping you navigate the treacherous terrain and reach your financial destination. Section 7. The High-Frequency Future. A brave new market. So, what does the future hold for HFT? Will it continue to dominate the market, leaving small investors in the dust? Or will it evolve, perhaps becoming more transparent and equitable? The truth is, no one knows for sure. But one thing's for certain. HFT is here to stay. Some argue that HFT has made the market more efficient. They say it provides liquidity, reduces trading costs, and helps keep prices in check. Others, however, remain skeptical. They worry about its potential to destabilize the market, create unfair advantages for large institutions, and erode investor confidence. The reality is likely somewhere in between. HFT has its pros and cons, and the challenge for regulators is to find a way to harness its benefits while mitigating its risks. This might involve implementing stricter regulations, increasing market transparency, or even exploring new technologies that could level the playing field. As for investors, the key is to stay informed, be prepared, and adapt. The market is constantly evolving, and HFT is just one piece of the puzzle. By understanding how it works, recognizing its potential impact, and developing sound investment strategies, you can navigate the high-frequency future with confidence. Remember, knowledge is power, and in the world of investing, knowledge is your greatest asset.